Hi there. Let's take a look at a key macroeconomic indicator affecting the level of aggregate demand, and that's consumer confidence. So consumer confidence is basically a way of measuring people's sentiments. As Keynes said, we need to track people's animal spirits. Are people more or less confident looking forward in terms of their expectations of their own jobs, their own financial circumstances, and their view about the wider economy in the months and years to come? So we typically use surveys of consumer confidence, and we'll look at a chart on that in a second. But here are some key factors affecting consumer confidence, such as the rate of growth of GDP. The headlines that people read in the papers can affect their perceptions. The level of household debt's a key factor affecting sentiment, as is also the cost of servicing that debt, in other words, the interest rate. The state of play in the labour market is a key factor affecting consumer confidence. For example, if unemployment's rising, confidence may take a hit, but if there are more people in work, sentiment should improve. And we know that there are positive relationships between the level of house prices and share prices and people's general confidence, although it's not an automatic, if you like, an automatic linear relationship. It can ebb and flow over time. So interest rates in the UK have stayed very low for a long time. Base rates 0.5% since March 2009. And crucially for homeowners, if you can get a mortgage, the effective mortgage interest rate in the UK has been nudging down towards 3% in the last few years. So interest rates falling, of course, good news for confidence of home buyers, but terrible news for the confidence of savers. Here's the change in house prices in the UK. This is the annual 12% change in average house prices. So of course it's going to hide variations across regions and within localities. But house prices were falling during the recession, and then they rose strongly and then dipped back again in 2011. Since then, house price inflation has been pretty strong. Since 2014, in fact, it's been above 5%. And of course, this has different effects on consumer confidence. For people with a home, the value of their property is rising and the equity within it is increasing. But for many millions of people in this country, home ownership is a distant dream. And with house prices rising, so too as the cost of renting a property. So here's our chart showing consumer confidence in the UK, and you'll notice that it's quite volatile. It does ebb and flow from month to month and year to year. So this is a kind of normalised index of consumer confidence, pictured taken by the OECD. And two things to really think about. One is the V, the collapsing confidence when the recession hit the UK in 2008. That really was quite a sharp fall in confidence. A rebound, but then another dip in 2012. People were fearful of a double dip recession. Since then, consumer confidence has actually improved quite markedly into 2015, where this data chart finishes. So we would say that the animal spirits of many consumers have improved, and that's been a factor driving consumer spending up, even though for many people real wages and real incomes have barely increased. Consumer confidence is at least now back to the levels it was at before the last recession, perhaps even higher. So confidence is a key variable. When you get a question, an exam question of what determines aggregate demand and consumer spending, you need to be talking about the importance of consumer confidence.